Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, Russia slashes small business tax-free income by 80%, pivoting to direct taxation to fund its war economy and risking private sector collapse. Today, we'll take a closer look at this painful trade-off between civilian growth and monetary stability and its implications for Russia's long-term economic resilience. Second, Trump administration cancels $8 billion in green project funding, targeting 16 blue states and injecting political alignment risk into US infrastructure investment. We'll examine how this move could chill private investment and undermine US competitiveness against Europe's carbon border tariff, the CBAM. Third, Fundstrat's Tom Lee forecasts a 7,750 S&P 500 surge, calling a government shutdown a buying opportunity despite high inflation constraining the Fed. So we'll discuss why this bullish historical parallel is challenged by high inflation and what it means for the Fed's ability to support markets. Russia's war economy is creaking, and the Kremlin has just decided who's going to foot the bill, its own small businesses. A new draft budget proposes slashing their tax-free income threshold by over 80%, and that's just the start. As the government scrambles to fund military spending, it's planning significant tax hikes across the board. The value-added tax, or VAT, is set to climb from 20 to 22%. The real shock, however, is for small businesses, where the threshold for paying that tax will plummet from 60 million rubles down to just 10 million. This move pulls thousands more entrepreneurs into the tax net. Now, this isn't just a simple tax adjustment. It's a move that dramatically accelerates the crowding out of Russia's private sector. These small and medium-sized businesses are, after all, the most dynamic source of non-state employment and innovation. By hitting them with higher taxes, the government risks hollowing out this part of the economy, making the entire country more structurally dependent on state-led military spending. The danger is that the economy becomes vulnerable to collapse if that military demand ever slows down. So the Kremlin is facing a classic policy dilemma. This decision to raise taxes instead of just printing or borrowing more money is a very deliberate choice. It's a direct attempt to give Russia's central bank some breathing room to eventually cut interest rates and fight off an inflationary spiral. However, this forces a painful trade-off. They are essentially choosing to sacrifice the growth of the civilian economy to maintain monetary stability. We need to watch inflation and retail sales data closely to see if this gamble pays off. All of this is happening as Russia's economic engine stalls. Projections show growth stuttering to just 1.3% in 2026, a dramatic drop from the 4.1% expansion recorded in 2024. An analyst at the Center for European Policy Analysis put it bluntly, saying the Kremlin is passing the war's costs to the whole of society. Another expert from the Carnegie Russia Eurasia Center confirms footing the bill will be the Russian people. What this signals is the exhaustion of Russia's previous wartime economic model. For the past couple of years, the government relied on debt-funded fiscal stimulus to keep the economy going, but that well is running dry. We're now seeing a major pivot to direct taxation. This is a much more painful path because it directly squeezes consumer demand and non-military investment, truly testing the public's tolerance for the war's economic burden. But this is where the situation takes a more complex turn. The budget reveals a clever accounting shift. While spending on national defense is set for a nominal decrease from its post-Soviet record, a related category, national security and law enforcement is projected to surge by 13%. Now get this. This is more than just moving numbers around. This recategorization is widely seen as a political maneuver to obscure the true ever-growing cost of the war. But there's another layer. Boosting spending on internal security forces like the National Guard and police while the public is being asked to shoulder a heavier economic burden suggests the Kremlin may be preparing for increased internal dissent stemming from this very economic pain. Russia's own finance minister acknowledged the focus is shifting to new challenges, including counter-drone systems, cybersecurity, and protecting critical infrastructure. The strategy is now unmistakable. While headline defense spending may appear stable, the financial burden of the conflict is being transferred directly to Russian households and businesses, threatening to strangle the civilian economy in a new era of forced austerity and low growth. Ultimately, this entire situation demonstrates the practical limits of Russia's fortress economy strategy. Despite having vast commodity resources, it cannot escape the severe economic friction of sanctions and a prolonged conflict without imposing punishing costs on its own society. This provides a crucial case study, particularly for a major economy like China, showing that even a powerful nation's economic resilience has a breaking point when faced with sustained external pressure and the immense costs of war. The focal point to watch going forward will be Russia's current account balance and foreign exchange reserves, which will tell us just how much financial pressure is building inside this fortress. Speaking of governments making controversial fiscal moves, we're now seeing a major political firestorm spark over budget decisions right here in the US. The Trump administration just cancelled nearly $8 billion in green project funding. The real kicker? All 300 of those projects were located in 16 blue states that voted for Kamala Harris in the 2024 election. What this does, essentially, is introduce what investors call political alignment risk into the US market. When funding is tied to political loyalty, it creates massive uncertainty. Private investors, who often co-invest alongside the government, get spooked. They start demanding higher returns to compensate for the risk that their project could be cancelled overnight for political reasons. The result? This could chill private investment in long-term US infrastructure, ultimately slowing down the energy transition. The move, announced during a federal government shutdown, is sending shockwaves through the energy sector. In California, a single hydrogen hub project called Arches lost over $1 billion in federal funding, putting a reported 220,000 American jobs at risk. In Washington state, another $1.1 billion for a hydrogen hub was cancelled, prompting Governor Bob Ferguson to call the move an outrageous attempt to punish blue states and vowing to fight the illegal action. And this isn't just about California or Washington. The ripple effects could derail the entire US national clean hydrogen strategy. We're seeing the European Union and China aggressively funding their own hydrogen economies, while the US risks ceding critical ground and future supply chain leadership in a key future energy source to its global competitors. If that was just the appetizer, the main course is just being served. Senate Minority Leader Chuck Schumer accused the administration of taking a wrecking ball to working families' lives and waging an endless campaign for chaos and revenge. This sudden cancellation delivers what economists call a transition shock to local economies. The promise of green jobs has been a major selling point for climate initiatives. When projects that are already underway are abruptly defunded, it tests the credibility of that promise. This could erode public support for future projects and, in the short term, create very real spikes in localised unemployment in the affected regions. But the Energy Department is firing back with its own narrative. Energy Secretary Chris Wright stated the projects were rushed through with inadequate documentation, were not economically viable, and would not provide a positive return on taxpayer dollars. The department claims the move is about protecting taxpayers and expanding affordable energy. This sets up a massive conflict. One side sees a politically motivated attack that will kill jobs and increase pollution. The other claims it's a necessary act of fiscal responsibility. Now, regarding the administration's fiscal responsibility argument, there are other economic consequences to consider. The connection to global trade is critical here because the European Union is rolling out something called the Carbon Border Adjustment Mechanism, or CBAM. It's essentially a carbon tariff on imports. By cutting funding for things like low-carbon cement, the US may be making its own manufacturers less competitive as their products will face penalties when exported to Europe. The fallout is already being calculated, with Colorado's Energy Office warning that the cancellations will balloon energy costs, threaten grid reliability, and create instability in the business community. So when you hear about threatening grid reliability, this is what it boils down to. Many of these grants were for improving the grid's ability to handle disruptions. Without these upgrades, affected states are more likely to see increased power price volatility and a less stable grid. This isn't an abstract concept. It could directly lead to higher electricity bills for consumers and businesses. It also undermines the business case for building more renewable energy, creating a negative feedback loop. So looking ahead, we need to watch regional power prices and investment data very closely to see how these effects play out. We were just talking about the economic risks created by government actions, but what if one of Wall Street's top strategists is telling you to ignore a major one? A top strategist is calling for the S&P 500 to potentially surge towards 7,750 by the end of the year, a forecast that directly challenges the market's biggest fear. Fundstrat's Tom Lee, the analyst who correctly called the 2025 bull run to all-time highs, is now urging investors to ignore the dire warnings of calamity over a potential government shutdown. He calls the issue a sidebar and argues that any market dips caused by shutdown fears should be seen as buying opportunities. This is a bolder claim than it might seem at first. A prolonged government shutdown creates what's called a data blackout. The government stops releasing critical economic numbers, reports on GDP, inflation, and employment that everyone, especially the Federal Reserve, relies on. The thing is, we're in an era where the Fed is extremely data dependent. A few days ago, we mentioned that the Fed has been cutting with one hand while waving a caution flag with the other. Without official data, that dynamic gets louder. Policymakers are forced to lean on patchier private proxies, which boosts uncertainty and volatility. In a direct note to clients, Lee stated we would not lean bearish because of shutdowns. If stocks are down, we would be dip buyers. Continuing our last discussion, remember the new Fed put? We highlighted a focus on genuine credit and leverage risks rather than just high stock prices. In a headline-driven sell-off without credit stress, don't expect the Fed to ride to the rescue simply because equities wobble. His argument isn't just bravado, it's backed by decades of data. Lee points out that since 1950, the S&P 500 has historically posted a median fourth quarter gain of 4.9%, with an 81% win ratio. This historical pattern is powerful, but there's a catch. Some leading economic indicators are flashing warning signs. Take the Consumer Confidence Index, which has been falling. A key part of that index, the Expectations Index, recently fell below a level of 80. Historically, that has often signaled a potential recession within the next year. Continuing our last discussion, the tug of war between supercore services inflation and the labour market is still pivotal. If services inflation stays sticky and employment remains resilient, the cautious camp inside the Fed wins, meaning fewer and slower cuts. The core of his argument, however, hinges on a powerful parallel to 1998 and 2024, 2 years when the Federal Reserve cut interest rates in September. Following those cuts, the stock market index rose an average of 13.8% in the final 3 months of the year. A repeat of that exact pattern is what would push the S&P 500 toward that stunning 7,750 target. This comparison is central to his thesis, but it brings up a critical difference: inflation. The situation today is fundamentally different from 1998 and 2024. Back then, inflation was very low, around 1.5 to 2%, which gave the Fed a green light to cut rates aggressively. Today, however, inflation is hovering around 3.8%. This high baseline acts as a constraint on the Fed. They have much less room to be dovish without risking another surge in prices. For our listeners in the Chinese-speaking world, this is particularly relevant. A less dovish Fed generally means a stronger US dollar, which can put pressure on the exchange rate and influence capital flows in Asian markets. The core conflict is clear. While much of Wall Street fears that a government closure could cripple a fragile economy, Lee is betting on a different force: a strong seasonal tailwind combined with a dovish Fed. He sees widespread political fear as a massive buying opportunity for the bold. So the situation presents a fascinating duality. On one side, we have a powerful historical argument for a rally. On the other, we see serious economic headwinds like falling consumer confidence and an inflation problem that limits the Fed's power. This distinction matters because some analysts believe the recent rally across different assets, stocks, gold, even Bitcoin, isn't driven by a strong economy, but by excess cash in the system and the expectation of falling real interest rates. This could mean the market's foundation is fragile and highly dependent on central bank policy. And tying back to our earlier point, a hot market can fuel the wealth effect, which can be inflationary and paradoxically keep rates higher for longer. So what should we watch for next? The near term will be a battle between Tom Lee's bullish historical parallels and the reality of current economic data. If inflation data comes in hotter than expected, it will reinforce the idea that the Fed's hands are tied, which would be a major headwind for stocks. However, if we see signs of a rapidly weakening economy, it might force the Fed to pivot, which could boost assets like gold and bonds. Beyond the next CPI and every word from the Fed, keep an eye on supercore services, inflation, the jobs, data, and indicators of leverage and credit risk. This information is for informational purposes only and does not constitute investment advice. Market conditions are volatile and past performance is not indicative of future results. All financial data is based on market conditions at the time of reporting and is subject to change.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.